Building a hyper-diversified portfolio doesn't have to mean juggling 10 or 20 ETFs. In fact, for many investors, the most efficient solution is a single, well-designed ETF that already does the heavy lifting for you. Today on the ETF Investor, we're breaking down how one ETF can function as a complete, hyper-diversified portfolio. We'll look at what makes an all-in-one ETF truly robust, what asset classes it should include, and which single ETF solutions stand out for investors who want simplicity without sacrificing diversification. The core idea behind a single ETF portfolio is broad exposure. Instead of choosing separate funds for U.S. stocks, international equities, bonds, and alternatives, these ETFs bundle everything into one vehicle. The result is instant diversification across geographies, sectors, and asset classes with one purchase. The first category to understand is global equity ETFs. These funds invest across U.S. and international markets, often covering both developed and emerging economies. By spreading exposure globally, investors reduce reliance on any single country or economic cycle. This matters because leadership rotates. What outperforms this decade may lag the next. A strong example in this space is Vanguard Total World Stock ETF, ticker VT. VT holds thousands of stocks across the globe, weighted by market capitalization. It gives you exposure to U.S. large caps, international developed markets, and emerging markets in one fund. The strength of VT is its simplicity and low cost. The limitation is that it's 100% equities, which means higher volatility during market downturns. That brings us to the second building block of a true all-in-one ETF, fixed income. Bonds play a critical role in reducing volatility, providing income, and cushioning drawdowns. Single ETF solutions that include bonds tend to be more suitable for investors who want smoother returns and less emotional stress during market corrections. A well-known option here is Vanguard Balanced ETF, ticker VBAL for international markets or for U.S. investors. Funds like Vanguard Life Strategy Growth ETF, ticker VSGX in mutual fund form. These types of funds combine global stocks and bonds in a predefined allocation, automatically rebalancing over time. You get diversification and discipline without needing to manage it yourself. The third layer that separates good all-in-one ETFs from great ones is exposure to alternative assets. This can include real estate, commodities, or inflation-sensitive assets. Alternatives help diversify risk further, especially during periods of inflation, rising rates, or equity market stress. An ETF that moves in this direction is the iShares Core Aggressive Allocation ETF, ticker AOA, or its more conservative counterparts like AOR. These funds combine global equities, bonds, and sometimes indirect exposure to real assets through REITs or commodity-linked equities. While they don't fully replace dedicated alternatives, they add another dimension of diversification inside a single fund. One of the most comprehensive single ETF solutions is the Vanguard Life Strategy series. These ETFs are designed as complete portfolios with fixed risk profiles, ranging from conservative to aggressive. They hold multiple underlying Vanguard funds covering U.S. stocks, international stocks, and global bonds, and they rebalance automatically. For investors who value consistency and simplicity, this structure is hard to beat. So who is a hyper-diversified single ETF portfolio best for? First, long-term investors who want broad exposure without constant tinkering. Second, beginners who want to avoid complexity and behavioral mistakes. And third, experienced investors who want a core holding they can build around with smaller satellite positions. However, there are trade-offs. You give up customization. You can't easily overweight a specific sector or region without adding additional ETFs. You're also fully dependent on the fund's allocation decisions, which may not perfectly match your personal risk tolerance or market outlook. Costs matter as well. While many all-in-one ETFs are low cost, some multi-asset funds carry higher expense ratios due to their complexity. Always understand what you're paying for and what assets you're actually getting. The bottom line is this: a single ETF can absolutely function as a complete, hyper-diversified portfolio if it offers global equity exposure, high-quality fixed income, and thoughtful diversification across assets. For many investors, less complexity leads to better outcomes, not worse ones. If you're looking to invest with confidence, discipline, and minimal effort, all-in-one ETFs deserve serious consideration. If this breakdown helped, subscribe to the ETF Investor, and let me know in the comments whether you prefer a one ETF solution or a multi-ETF portfolio, and why.